Fantastic. Very good afternoon to you all. Welcome to this webinar on news trading, a strategy you can bank on without even knowing or caring what the news is. Trading is all very well and good, but as I'll discuss and show you in this webinar, you can really do it very profitably without even knowing or caring what the news is. Okay, a lot of people spend a lot of time really agonizing over what the number is going to be and how best to play it. And I'm going to show you a way how you can really just manipulate odds in your favor here. Okay, without further ado, I just want to show you a little bit about who we are and how you can benefit from us. This is presented by thelazytrader.com. We are accredited by the Society of Technical Analysts, and so are coaches, and we have a Forex Peace Army rating of 4.6 out of 5. I'm Rob, founder of The Lazy Trader, and I've been trading since 2007. And yeah, I've been trading Forex, stocks, commodities, and I've been writing for and contributing to FX Street, Forex Peace Army, FX Empire, London Investment Week, you know, the usual suspects if you like. And when I'm not trading, I enjoy, well, I'm not trading most of the time actually. I'm enjoying lots of other things like traveling, photography, tennis, and mentoring people starting their own businesses at the Prince's Trust. Anyway, you didn't turn up on your Wednesday afternoon to hear about me, or Tuesday is it today? I don't even know, to be honest with you. I believe it is Tuesday, sorry. But anyway, you didn't turn up on your Tuesday afternoon to hear about me harp on about myself. So without further ado, let's go straight into the webinar. Just get a quick glimpse of this disclaimer. And I just want to talk to you first about why we don't worry about the news. First of all, this approach gives us a peace of mind. We can trade in a very peaceful and relaxing manner. We need to reconcile the fact that there's no way we can predict the news. So with that in mind, we can just trade with odds in our favor. And we always make sure we select trade setups with a high reward to risk profile. If you're confused at this point, don't worry, all will become very clear very soon. So let's just scroll forward. We trade the daily and the weekly time frame, okay, because it's the more stable time frame, it's the dominant time frame, and essentially the levels, the trends, everything like that are a lot more susceptible to the news. So of course we trade with a bigger stop, i.e. a bigger distance between our entry price and our stop loss, but that's absolutely fine because we're able to give the market room to move against us. And you know, there's no way of guaranteeing that news can be in our favor or not. Okay, so we just trade with the probabilities. If we see a setup with high reward to risk, then we take it because, of course, news could either go in our favor or not. But if we're wrong, we only lose a small amount. If we risk 1% or 2% of our trading account, and if we're right, we can make sure we're in the game for a very big win. Okay, so with our trading, we're not fundamentalists necessarily. Of course, it's good to have idea of the context of the market in terms of interest rates and the general kind of theme. But, you know, we're not number crunchers. There's only so many resources we can have at home trading, looking at the charts, okay? You look at these big hedge funds out there and banks, institutions, they've got access to a whole ream of data, and certainly they don't trade in the same way. They'll trade based on fundamentals. We, retail traders, we trade on technical analysis, okay? It's a level playing field for that reason, okay? But we have our edge, and this is the strategy, okay? So, like I mentioned, we have no access to the inside circle. We don't have any insider information, so to say. If any of you know anyone, do let me know. Wahaha. Of course, to try to guess the news, there's always that old chestnut, which a lot of people try to kind of figure when they're new to trading and generally get very badly burnt. It's a mug's game, don't bother. It's my simple response to that. Some people get it right some of the time. Some people get it right most of the time, but nobody gets it right the whole time, okay? So, you know, looking at the chart, we're able to gauge probabilities, look for setups with high profit potential, and essentially reconcile the fact that if we're right, if we risk manage then and go for a high profit potential trade, then we can make a profit. If we're wrong, we only lose a small amount, okay? So, like I said, news, okay, it's a 50-50 chance of news going in our favor or not, okay? So we need to prepare for that, all right? So this is where we select trades with a high profit potential, like a minimum of a 3-to-1. If it goes in our favor, 50% chance of news will go in our favor, then it at least helps perpetuate a winning trade. If the news goes against us, then at least we know we've only lost 1% of our capital. So it's very similar to like flipping that coin, knowing that if we bet on heads or tails, if, for example, it lands on heads and we're right, 50-50 chance, and we win, say, £300. If we're wrong, then, of course, we lose £100. So, of course, bearing that logic in mind, we could do very well long term. I know there's always these black swan events, but risk management over the long term and adapting to the evolving market will help eliminate black swan events. Okay, so trading good reward is a real secret to trading, by the way. A lot of people think, okay, this is simple stuff, I'm not going to listen. This is one of, for all my discoveries, analysis, further education courses I've attended, experience in the markets, I can safely say that the real secret is going for high reward to risk. A lot of people say a strategy, or I found a strategy of 90% probability of success. When people say that to me, I'm like, great, come back in a year's time, I'm not interested. And generally what happens in a year's time is people come back to me and they simply say, well, I had a steep drawdown with this strategy, and of course being inverse reward to risk, they've what could have been a relatively small drawdown, there's been a huge drawdown. So this is why strategies which have a high success rate essentially have very poor inverse reward to risk. So if it's 90 or 80% successful, you know that if the market changes and those inverse reward to risk winners essentially lose and you're taking a full hit, then that extremely high success rate is going to blow up your account when you get a drawdown. Whereas if you have a relatively lower probability strategy which has higher profit potential, then you've got the blessing of the fact that, okay, if it's right 30% of the time, for example, 40% of the time, then and you're still gaining overall thanks to high profit potential like 3-to-1s or 1-to-1, sorry, 2-to-1s or more, then at least you know that if that 30% success rate is increased, then that really would accelerate your profits a lot more so. Okay, so I just want to clear up that misconception amongst a lot of traders. I'd far rather go for the strategy with a lower probability, with higher profit potential, rather than the strategy with higher probability, with lower profit potential, i.e. lower reward. Okay, hope that makes sense. I've got that bit out of my bonnet now. Let's go back to the presentation. Okay, so for every trade we place, we risk no more than 1% of our trading accounts, all right? 2% absolute max. And I don't place a trade unless I've got at least 3% profit potential, all right? Within the realms of possibility. So, of course, we want, if for example, the reversal or the trend-based trade we're taking goes in our favor, it would be a shame to cut the position and take off the winning trade when we can just let it run, for example. This is why I can sometimes assert the notion that targeting is a pure fantasy for that very reason. Okay, so let's move on. Like I mentioned to you, where there's reward, the higher the reward, the lower the probability. And the higher the probability, the lower the reward. Okay, so this is why I'm very big on strategies on the higher time frames, which may have a relatively low probability, like 40%, 30% or below, but the reward is high because the market can only turn in favor of that in terms of the probability over the long term. Whereas, like I said earlier, if a strategy has a 90% success rate and the reward per trade is very small and it's inverse, like you're winning 0.5% for every 1% gain, risk, then a drawdown would decimate your account. Okay, so we only place trades which have a 3-to-1 reward to risk profile because, like I said, if the news is in our favor, we have no previous way of knowing that the news is going to be in our favor, then if it is 50-50, we win big. If we lose 50-50, we lose small. All right, so it's really playing the odds in our favor. Of course, if we see a trend with good order angle and separation, with key higher highs and higher swing lows, then we know that the news is probably going to continue to be in favor of the trend because the trend is reflective of the underlying state of an economy or a trading block. Okay, so for those of you who are relatively new to trading, I just want to really kind of like do some housekeeping here and talk about the reward to risk equation here. And this should be really kind of observed regardless of how much money you have to trade. A lot of people think that if they've got a small account, they don't need to bother with this. When I say it's absolutely essential for you to do this, no matter what the size of your trading account is. Okay, because you can't get consistent risk-adjusted profits on a $1,000 or £1,000 trading account, then you're not going to do it on a bigger trading account. And if you're when you're new to trading, you should be looking to get consistent first, the money later after consistency. Let's not have that flash in the pan desire for instant gratification yet or at all in trading. Okay, so the formula is to get reward to risk is entry price take target price over entry price minus stop price. Okay, and the example is here. So if we've got a distance between our entry price and our stop loss of say 178 pips, and that's divided by 45 pips of risk, and we've got 3-to-1 profit potential, then that's a good trade. If we've got any less than 3%, or God forbid any less than 2%, it's probably not worth the trouble. Okay, so I'm just going to show you an example here. I'm a very visual person, and I'm sure you'd appreciate it in plain sight as well. So I'm just going to give you this pound New Zealand trend-based trade. We've got order angular separation with the moving averages with downtrending. Our entry price is here, and our stop loss is at 21.28. We've got 168 pips risk, and our target to a new lower low, targeting 578 pips means that we essentially have 575 divided by 167 equals a 3.4-to-1 reward to risk trade. And that is what we want, because if we are risking 1% of our trading account, say if it's like a £5,000 or $5,000 trading account, then we can reasonably expect 170 pounds return on it if it hits target. Whereas if we lose a trade and it goes the other way, then at least we know that the maximum we can lose is £50. Okay, so regardless of what the news is, we know that if we're right, we can win 170 pounds or dollars. If we're wrong and the news goes against us, then we've at least lost £50 or $50. Okay, remember that example I gave of the 50p coin, heads or tails? It's the same story here with dollar CAD. Say, for example, we've got 86 pips risk and we've got 245 pips profit potential down to the previous swing low. Say we're trading this evening star, pin bar reversal, high test bar, whatever you like to call it, off the 100 moving average, and we're trading it to a new lower low for target 2, but the previous swing low for target 1. We know that we have decent reward to risk. We've got 2.8-to-1, given that we can divide 245 pips by 86. Same deal with the loonie. No, sorry, euro dollar, my apologies. We have this trend-based trade, this doji bar here, entry halfway down the bar, 45 pips risk, 243 pips potential profit, up to the previous swing high. We know that we've got 5.4-to-1 reward to risk trade, because we can just simply divide 243 by 45, knowing if we hit target 1, we can at least, regardless of what the news is, if the news goes in our favor, we can make a potential of £2,700 if we're risking £500, 1% of our trading account, or we can lose £500 if the news goes against us and this trade is wrong. Okay, so this is why if any strategy, if you're backtesting mechanically on a chart over time, you're not going to be thinking about the news and what happened every day. Okay, backtesting results for those people who backtest in their free time, meta stock or anything like that, you know, it doesn't take into any account what the news was on any day. It will just give you the mechanical results depending on what the strategy parameters are. This is why I don't care about news, because I've got positive reward to risk, and so should you if you're trading the higher time frames. Trading the higher time frames has many benefits. You're immune to the news, you're a lot less susceptible to intraday spikes, and you can just enjoy a less high maintenance trading modus operandi. Okay, so last example here, we've got CAD Swiss. This is the lovely range-based trade which you took, must have been a couple of years ago now, but still got many more contemporary examples coming up. We've got our entry price at 94.5 and our stop loss below the inside bar here, 38 pips risk, 508 pips potential reward. And this is where we've got a 13.3-to-1 reward to risk trade. Okay, so if the news goes against us, and it could send the price going downwards and stopping us out for 1% or 2% loss, depending on how much you risked, and we can only lose a small amount of our trading account. Say we risk £100, the worst thing that we can do is we can lose £100. But if we're right, then we could potentially make a lot more, okay, in the thousands. Okay, so in a nutshell, we are just simply looking to risk no more than 2% of our account per trade. Never fail to use a protective stop loss, because of course, even the best looking trade setups can go against you. And I would say pick trades of at least a reward to risk ratio of 2 to 1. All right. The risk management and targeting trades of high profit potential, very important for the reasons I mentioned. Okay, and I'm going to give you a few examples of this, because it's one thing me just giving you some theory and plucking some picture perfect trade ideas from the past, but I just want to really kind of bring this to the current day, okay, because it's real life, and I'm sure you'd appreciate that. All right, I'm going to show you a couple of trades we're in now. Let me just drag this across Q PowerPoint. There we go. Okay, so I'm going to talk to you about gold at the moment. We're in gold, and we took this on the weekly time frame. I'm going to show you the setup, and basically, if we look at the weekly here, I'm going to go back in time. So I want you to see this as through the eyes of how our traders did. Okay, so gold, this was a trend-based sell trade. We've got great order angular separation between the 200, the 50, and the 20 moving averages, and we've got an opportunity to sell here. Not only do we have an inside bar here on the weekly time frame, it also is the completion of a Gartley formation here. If we take the Fibonacci down from the last swing low, for example, this part here, we can see that we've got this impulse wave here, and we've got the corrective ABCD pan into it. It plays the 786 Fibonacci level, and for those people who trade Gartleys and harmonics on their own, they'll just simply place their orders to sell on the 786 with their stop loss above the swing high here, last seen in July. However, we said, well, we've got the price action based confirmation of an inside bar here, bar of indecision. We can see that the 50 moving average has been previously tested once. We can see here that a lot of amateurs will probably be thinking, whoa, gold's reversing now to the upside because of this double bottom long. This is actually an ABCD corrective formation. When we have A to B equaling C to D, copy paste, we've got symmetry between A to B equaling C to D. We can reasonably expect there to be some kind of turning point around about here, where a lot of people who have new to the markets have just got very excited thinking, whoa, we're going long for gold. We've got this high low. It's a reversal pattern. Gold long, everyone. The smart money are thinking, actually, yeah, this is ready for a sell. Okay, so you can see two competing schools of thought here. You've got people who are relatively new to the markets looking for free strategies on the internet, head and shoulders and double top, double bottom reversal patterns. And you've got people who essentially trade harmonics, and they've got two opposing mindsets here. But regardless of whether you understood the Gartley or not, that's a different webinar for a different day. This is a sell opportunity with the trend, and regardless of whether it's a double bottom or not, 80% of reversals fail anyway, so it makes sense to go with the trend. And regardless of that, we knew the reward to risk was in our favor. We had non-farm payroll the week after we took this trade, but did it really bother us? Not really. Non-farm payroll is the biggest number every month to come out of America, and we knew, okay, fair enough, well, our first target was the previous swing low here. We knew that we had at least a 3 to 1. So we've got 86 divided by 23, which equals 3.7 to 1. Or if you risk 2%, like we do, it's a 7.4 to 1 reward to risk trade. All right. And we knew that non-farm payroll was going to happen between where we entered and where the trade could go. But we didn't care because we knew, okay, worst case scenario, non-farm payroll is going to be have numbers which are positive or negative. Okay, if they're positive, then that's going to send indices flying and going up because it's a good sign for America, and it was. But the thing is, gold went short off the back of it, i.e., we had this big move down to the downside, and it helped perpetuate a winning trade outcome to our 7.4% profit trade. We're still waiting for it to hit our first target here. Just about touched it, actually. Some of our clients actually scaled out, but we're waiting for it to break the previous swing low here. Okay, so we knew that, okay, non-farm payroll, it could be an agreement of our trade. Great. If it is 50-50, then it would help perpetuate a 7.4% profit potential outcome. But if it's against our trade, we only stand to lose 2%. And this is the essence of trading with the news, okay? Or not really caring what the news is. All right, so that's gold. This is the current week where gold is. And we're just waiting for it to come down. It's looking very bearish indeed. The next number for gold is 1,000. Here we are, and we've got plenty of downside between now and then. So we're still got half our portion of our trade in this one. Okay, so that was gold. So hopefully you're able to see a kind of clearer idea as to what we're doing here. I want to talk to you as well about another trade we took. General election in the UK. This was the daily time frame all the way back in May. I know I might have mentioned, some of you might recognize this charts, because I know I've recognized a few names in the room. FX Boyke, how you doing? FX Trad, yep, I recognize you as well. But that's besides the point. This example is a key example, all right, of why the news doesn't matter. Okay, so this on the 6th of May this year was the eve of the general election where the Tories and New Labour, or Labour as they've now rebranded themselves, were neck and neck. And, you know, the media didn't know what was going to happen. It was very 50-50. Okay, but we, regardless of how the politicians were doing and what their propaganda they were spewing, we saw this buy setup. We had this pullback, buy the dip opportunity, bullish pin bar reversal, morning star, low test bar, whatever you call it. We had this on the 6th of May. And we knew full well that, hey, okay, what is the worst possible thing that can happen if we take this trade? Okay, we lose 2%, however much you risk per trade, that's 2%. There's the best possible thing that can happen is if the verdict of the elections is favourable and the Tories win, and that's what happened, then we could potentially make this much upside. Okay, so we risked in pips about 200 pips in order to make 850. All right, so this was just target one here, the previous swing high, and that was target one, and target two was this level here. Okay, 1.618 Fibonacci extension. Let me just draw that in for you. Okay, so we'd scale out at this point here and take further profit here because we could see that previous swing highs to swing lows played to that 1.618 Fibonacci extension on several previous occasions. So the news was released that evening. The Tories won. Great. Okay, so this is a prime example of news. We had no idea what's going to happen. We knew that if we were right and news was in favour of our trade, we would be very right and make a shed load of money and pips. But if we were wrong, the amount we lose, thanks to risk management, will be very small. Okay, so we took this trade to the previous swing high. Some of our clients did. There we go. And some of our clients, some of the braver clients, held out after banking their profits here to the 1.618 Fibonacci extension and went through the purgatory for several months here. Let's see, even that trade open on the daily. There we go. Boom. That's the second trade profited. So they risked essentially 200 pips in order to make 1,521. Okay, not bad really, is it? 7 to 1 or 14 to 1 if you're risking 2% on the trade. Okay, so that's the power of essentially entering a trade at a key turning point and the news going in your favor and letting your winners run. You've heard me say that before. Let your winners run and cut your losses. Sorry about that. We're just waiting for the ambulance to go by. So yeah, you see exactly what I mean here about letting your winners run and letting your losses, or cut your losses early, okay? And the market will generally decide that for you. This is why risk management from the outset is very important indeed. All right, so this was Pound Aussie, and as the Pound Aussie is it's an underrated currency pair. I'd recommend that people look at some of these less known currency pairs because like any other currency pair, they move and shake in exactly the same way, and that's very important. Okay, so I'm just going to talk to you about the Scottish referendum on the FTSE as well. This happened last year. Another landmark bit of news which really played into our hands. Let me just get the date up. May 2014. There we go. Nope, it was in September 2014. I'm going mad. Here we go. So the Scottish referendum on the 18th of September. We're already short on the FTSE here at this point, thanks to this classic setup and this penultimate all-time high here. A number of our clients took this as an evening star. A smaller percentage of our clients just placed a sell level on this horizontal level and just waited for it to go down. That's absolutely fine. Either technique works. So what happened was, okay, we're waiting to get to the bottom of the range here. You know, it's just been ping-ponging for the past year and a half before the referendum last year. The FTSE has just been range-bound. So we just thought, okay, well, if fast forward to the 18th of September, the Scots essentially voted that they wanted independent Scotland, we knew that this was going to benefit our trade because the markets don't like uncertainty. And Scotland, a 300-year-old union coming unravelled after a referendum is going to give the market extreme jitters. So we knew, okay, we're already in this short. So it's going to help perpetuate a winning trade to the downside. All right. But if the referendum proved that Scotland wasn't going to be independent from the Union, then we knew that the FTSE was probably going to rally off the back of it. Depends how much the market expected the no referendum to essentially prevail. Okay, so we were short, we moved our stop loss to break even, and this is what happened. And the market continued to go down anyway, despite the no verdict. And yeah, some news, despite what people expect to happen, did the opposite. But we were still in this losing, well, the FTSE was losing in value or going down in value, but we were still in this winning trade to the downside, even though it wasn't congruent with the good news, or in my opinion, that Scotland was going to say no to independence. Okay, so this is an example of a news trade. For those of you who were at the time completely oblivious of the Scottish referendum and the outcome, you would have still had two technically based trades here. One here, this evening star, the second evening star here, two sell opportunities, regardless of what was going on in the news. And certainly those of you who backtest would have identified these as two bona fide opportunities. And, you know, the reward to risk does make sense. I mean, this opportunity here, which we saw, we had a fantastic reward potential. The second opportunity here, risking about 66 points to gain 291. 291 divided by 66. That was a good 4.4 to 1 reward to risk trade. Risking just 1%. 2%, or 8.8 if you're risking 2%. All right. So this is why, certainly for us, the biggest secret to trading is always going for high reward to risk. It's absolutely imperative. Okay, even if probability is slightly compromised. So that's the FTSE. I just want to talk to you about a couple more examples as well. Okay, so we've done the Scottish referendum, we've done the UK general election, and we did the non-farm payroll. Essentially, that move of gold this month just gone. But now I want to talk to you about the ECB rate cuts all the way back in September 2014 for Euro New Zealand, a cross-currency pair, which is underrated. I just want really you to reassure you that these lesser-known currency pairs, they move and they shake in exactly the same way as the majors do, and it would just be a shame just to ignore them completely if you're trading the hard time frames, because quite frankly, they move and shake in exactly the same way. The profit potential, the same mechanics, essentially govern them as they would the majors. Okay, this is why when people ask me what currencies do you trade, I just say all of them. Okay, so we had all the way back in September last year, this time last year pretty much, we had this bearish pin bar reversal sell signal here. We knew that this was simply a bigger, longer term selling the rally opportunity in a downward trending market. So we had the third and final attempt to do that here. Entry below the low, stop loss above the high. And okay, this was the 26th of August. The ECB rate cut happened on the 4th of September. And there we have it. This is what happened. We had the rate cut there, and it just sent the market going against us. So against an appreciating euro and in our favor for a sell trade. Okay. So you can see here, risk small, win potentially big. The market came back and we were able to scale out halfway down to the previous swing low here. We scaled out, but of course we were able to get a full profit here because the market did come back to form a higher low ultimately, which, you know, isn't convenient, but, you know, does the market really care about what we do? Not really, but that's the nature of the beast really. Okay, and we just, like I said, a lot of people say, so do you look at the news? And I just simply say, not really, I don't care. And, you know, a lot of clients are very shocked to hear this, but, you know, I want trading to be as stress-free and as relaxing as possible. I didn't choose it as an academic kind of inquiry. I chose it to simply make a good gain on my money while I'm doing other things in the daytime. And this can be achieved really by only trading the daily and the weekly time frame, because they're low maintenance setups where you can just simply let the market work for you rather than simply working for the market. If you're trading the 5-minute, 15-minute, 30-minute, then you really are working for your money. And a lot of people fall into the trap where they've got their small trading accounts, like £5,000 or £10,000 or dollar or less trading account, and they're spending all day trying to trade that. Whereas Warren Buffett makes, I know as an investor, as opposed to a trader, but he makes fantastic returns on a consistent basis of 20% a year, which, you know, is absolutely excellent. But the fact of the matter is 20% on a £10,000 or dollar trading account is a great gain, but that's $2,000 or £2,000 for the year. Okay, how's anyone going to live on that? So even if you're trading 100,000 and you're making 20% gain on the year, you made 20,000, then, you know, again, that's quite a meager gain for the year. So this is why, instead of putting pressure on yourself to win in the markets the whole time, because the market will only give you opportunities as and when the market will. It doesn't care about how many courses you've taken, how diligent you are, how much you want to make money from the market. It will just do its thing regardless. And people who are patient and wait for the trade, wait for the market to come to them, are the ones who are rewarded for it. And the best way to do that in the most time-efficient manner is by trading the daily and the weekly time frames. Okay, so there are a few case in points for you. I just want to move on now and talk to you about the forthcoming. We're coming to the end of our presentation. I just want to just simply conclude by saying that we have no crystal ball and no predictive powers as to what's going to happen in the future. So it makes abundant sense to let our winners run and to cut our profits, cut our losses short. Okay. There's an article about that on the website, and it's one which has had many hits in recent weeks about that whole thing. Okay, so go for positive reward, risk small to win big. Okay, only trade setups that conform to your rules, and be diligent about it. Risk 1 to 2% of your trading account per trade. Only identify and trade setups which have a profit potential of at least 2 to 1. Okay, so let your winners run and cut your losses short. Anyway, I just want to talk to you about a little celebration we're having. We are very proud to announce that we not only have we had a great launch of our Traders Hypnosis audio pack, which has been updated by one of our resident traders. We've also had our 500th client sign up to the Lazy Trader, and we've got quite a thriving, rapidly growing community at the moment, and we want to obviously recognize that and reward you for coming and attending this webinar. I know that a lot of you have other things to be doing as well, so the fact that you've turned up says a lot about your levels of seriousness. So I just want to really give this to you in collaboration with FX Street. This is only valid until midnight. I want to give you access to our flagship Ultimate program, which gives you the skills and capability to trade any asset class in any market from as little as 10 minutes a day. This is lifestyle trading to the max, really. You'll be taught all the skills to trade the daily and the weekly charts on all asset classes, and it's valued at $1,997 and will give you 1 month's test drive for $30. You can see whether it's for you. It's an enormously popular course at the moment. We've had great feedback, great reviews, and of course, if you're not satisfied, we'll just give you a full refund, no problem. Okay, no love lost, no questions asked. Okay, so just to really kind of like give you an inside Scooby as to what it is, you'll be taught everything you need to know how to trade financial markets from 10 minutes a day, access to our video courses, all of our strategies, both basic and advanced, our Market Scope weekly market analysis webinar, which will really keep you on track and enable you to see the market through the eyes of a professional fund manager, and of course access to our Trader Hypnosis audio course, which has been updated, and many other bonuses. Okay, so if you want this, by all means, go to www.thelazytrader.com/forex training, read the terms, and use the promo code FXStreet to get your place. Okay, it's only valid until midnight tonight. Hopefully see you on the other side. If not, no love lost, but we would love to work with you if you're serious. Okay, any questions from this webinar? Well, I've got one here. Which moving averages am I using? Well, I'm using the 20, the 50, and the 200. Okay, the 20 is the blue, the 50 is the red, and the 200 is the green. Okay, well, in that case, thank you all very much for coming. Have a great day, happy trading, and I will speak to you soon. Thank you, Ina Muller. Very kind.